DPM Tharman, thank you for joining us here today. It's a pleasure and a privilege to speak with you today. So we heard in the introductions that you've had quite a bit of first-hand encounter with financial crises in your roles as finance minister and chairman of the MAS and on the IMF Policy Steering Committee and elsewhere. So I thought we'd start today by getting some of your views on what lessons we should take away from recent financial crises. And in particular, I think the big ones, or the two big ones in recent years, the global financial crisis in 2008, 2009, which, as everyone here knows, caused immense economic harm around the world. And that's continued in some form up to the present day, especially in Europe with major sovereign debt and banking crises. So let's start there. And you gave a speech last year in which you made the following observation, which struck me as quite interesting. Of the countries around the world that have systemically important financial institutions, there were 4 that seemed to come through and cope with the financial crisis quite well, at least relative to all of their peers. And so that would be Singapore, Hong Kong, Canada, and Australia.
I said it the other way around because I said Canada, Australia, Singapore, and Hong Kong because that made a nicer acronym.
Very good. Yes, I can see I need to get into that frame of mind. So I'd like to just hear your thoughts to start out with. What is it about those countries in their financial systems or the kinds of shocks that they experienced that allowed them to cope with the financial crisis relatively well?
I think nothing special, I think. I think if you just focus on that for a start, Canada, Australia, Hong Kong, Singapore, Hong Kong, we all did fairly old-fashioned things and tried to do it as well as we could. Banking is at the heart of a financial system and remains so. And you've got to pay very particular attention to banks, both with regard to what's on their balance sheets, as well as with regard to their risk culture. And that's something that has to be, that has to involve not just rules and laws, but it has to involve a very active interaction between supervisors and banks. It used to be the case in the US. In fact, we learned a lot of our tools of the trade from the US, from the Fed, from the New York banking authorities and others. It used to be the case in some European countries, but that culture weakened in the last, particularly in the first decade of this century. And we simply stuck to what we thought was important. It was nothing special, but it needed a lot of attention and needed doing it well. We leaned towards being conservative in banking. And that means ample capital, including core capital. It means significant liquidity buffers. We've been accused at times of being a little too conservative, and I think we probably were, but when you don't know what's coming more than 3 or 4 years in advance, it's good to have solid buffers in hand. I think the crisis itself has, there's a whole ton of analysis on what happened in the crisis, what should be done about it, but it's important to focus on the structural underpinnings of the crisis, and in fact the structural underpinnings that are still very much with us now. And there are probably 2 key trends that have been with us for over a decade, in fact for much of the last 2 decades, which are still there and are still not being addressed adequately. This wasn't a financial crisis. It was a crisis in social compacts, and it was a crisis caused by the evolution in the global economy and in technology. The social compacts which have defined Europe and the United States and Japan for that matter, for much of the post-war period, has reached its limits. Political commitments have outrun the ability of economies to pay for them. And the ability of the current generation to push the burden of paying for commitments to the next generation has also reached its limits. So that's we call it fiscal policy, but it's actually a social compact that's in crisis. It needs refashioning. Refashioning in a way that's not just about solving a crisis, but refashioning in a way that's equitable. It's equitable. Because despite the coloring and shape of the social compacts, it's not all equitable. It's not all equitable to sort of keep expanding promises to a current generation of retirees in the West, who are often much better off than young workers, and cut back on education and social provisions for mobility, let alone cut back on jobs and benefits for existing workers, which is what's happening on a massive scale at the state level as well as federal level in the United States and in Europe. So that's the first problem. The second problem, which is also very much with us, is the structural shift in the global economy that has led to a loss of competitiveness in a range of jobs that the US and Europe used to be very good at. Technology is a good reason for it, a large part of the reason for it, but it's also to do with the entry of a very large number of Chinese, Indian, Brazilian, and many other workers into the global economy. The suddenness of the shift poses problems, but we have to come to grips with it.
Right. Okay. Can I go back to two of the matters you pointed out earlier in your response? One, I think, was sufficient levels of equity capital in financial institutions, and I thoroughly agree with that message, and I think that's a message that has been widely understood to be a failure of the financial system in much of the U.S. and in Europe pre-crisis, that there weren't sufficient capital levels. There are real challenges, I think, about bringing that about, but I think there's not much dispute that we need to move in that direction. But you also raised something else, which I think is more subtle, that I wanted to probe a little bit with you, which is the importance of risk culture and cultivating the right type of risk culture, both within financial institutions and I think in the regulatory system. That strikes me as a much harder thing to bring about, and frankly, I wonder whether all societies that have large-scale banking systems really have the wherewithal to build the right kind of risk culture, because it requires a certain level of technical expertise, but it also requires the right set of institutions. And let's take the United States, for example, which I think had the technical expertise, at least historically had some of the right institutions, but somehow fell short over time. So I wondered if you could speak to how is it that a society can cultivate the right risk culture?
So first, I don't think we have developed a particularly good risk culture ourselves. I think that's very much a journey we are on, and I don't think we are more sophisticated at it compared to many other economies. I think there are a few dimensions to this. First, when we talk about risk culture within a bank or financial institution, the first phase involved lots of very useful improvements in corporate governance that involved box ticking. And it's not meaningless. I mean, you've got to at least be able to tick the boxes.
Right.
But it has to go well beyond that. And what we haven't seen very much of in Asia or in the West is a culture of questioning on the part of boards. Boards are typically not comprised of experts in banking or finance, and in fact the whole merit of a board is it brings diversity and outside perspectives. But the breadth of perspectives is only useful if it's brought to bear on if you're able to ask questions that are out of the box, that are beyond the horizon, or questions that might appear stupid. And you've got to be willing to ask stupid questions if you're on a board, and have management give frank and honest answers to them. And I don't think anywhere in the world we've developed in financial institutions that culture of active questioning on the bottom boards. Secondly, on the technical side, I think if anything, we've been too comforted by the use of techniques, the varying degrees of sophistication in VAR models, which boards didn't understand very well and were therefore mesmerized by. I think reducing risk to a number or even a set of numbers was a very dangerous tendency. And there was a lot of that in the last 10 to 15 years. So the big issues are not about short-term VAR. They're not about implications of past volatilities for the future. The big issues are about structural changes in volatility and risk, about things that are on the horizon and not yet already apparent in the data.
So let me just pick up on that, because as I was listening to you talk, I was thinking about the fairly vigorous effort in the United States to introduce a stress testing regime for financial institutions. And one criticism or concern that has risen recently is, okay, we started out encouraging financial institutions to think more broadly about their risk exposures and potential risk exposures, not be limited just to what happened in the last 5-10 years. But what seems to be happening over time is that financial institutions in the United States are trying to anticipate what kind of submission in the stress test will meet the expectations of the Fed. And so there's going to be some natural reconvergence to ticking the boxes in the expected way. And I worry, and I wanted to get your reaction to this, that we're going to get back to kind of this mechanistic approach to risk management, which is certainly part of it, but doesn't speak to the broader, the unknown type questions that you were alluding to earlier.
So I think that's a very thoughtful point, and I agree fully with you. There are some ways to mitigate that risk, and one of the very useful methods, I think, is what is called reverse stress testing. In other words, what will it take to posit a situation where you fail or where you're desperately short of liquidity, and then you work backwards and ask, look, what possible scenarios can lead to that? And also define an outcome that's undesirable and that you never want to be in, but which can happen, as we know. And then ask yourself, what scenarios could lead to that? And are they so implausible? And I think that's a useful intellectual exercise and a useful board exercise that can be used as a staple of developing this risk culture. It is beginning to be used in more institutions. But I'd also maybe make another point, if I could, about a risk culture that has to do not just with individual institutions, but with banking as a whole, shadow banking added in the whole financial system. Because something also went wrong there, not just about mistakes in micro-prudential management, but mistakes on a macro scale. And I think what went wrong is that we lost sight of the fact that leverage doesn't enhance returns. I mean, it's an utterly simple point, but we lost sight of the fact that leverage only redistributes returns and risks, and unfortunately often redistributes risk to people who can't absorb it. There is at any point in a cycle, there is a finite amount of productive economic activity that earns a positive return. The volume of activity that earns a positive real return is finite. And if you build more layers of leverage on top of that finite volume, you're bound to get problems. You're bound to get problems. So the overall leverage in a system is a very simple indicator that everyone should stare at. And there were, of course, problems of transparency because of the OTC derivatives market that obscured the level of leverage in the system. But within the conventional areas, it was staring at us. And there were specific mistakes made in banking supervision and in supervision of the investment banks and in insurance, despite the data that was staring at everyone. Leverage was allowed to grow by multiples, when in fact there was no change in the volume of economic activity that was productive in earning a good positive return.
Yes, we fooled ourselves to some extent into thinking that these fancy risk management tools allowed us to operate with greater degrees of leverage, at least in the United States, I think. And,
Yes.
and a failure to exercise the kind of imagination beyond recent history that you alluded to in the past. There was a study done at the Brookings Institution, or published by the Brookings Institution some time ago, that gathered data on the scenarios that major investment banks had used to project what might happen in the U.S. housing market. And these were projections done as of 2005, 2006. And the striking thing that sticks in my mind about those projections is that their worst case disaster scenario was a 5% decline in housing market values nationwide in the United States, on which they put something like a 10% probability. So that was a clear example to me of a failure to think beyond the period of the data that they were plugging into their models.
Yeah. And plus the confusion between financial returns and economic returns. Leverage doesn't enhance economic returns. It
Right.
enhances financial returns in exchange for higher risk. And because of the globalization of finance, plus innovation in financial instruments, the risks and returns have been distributed in highly inefficient ways. And ordinary savers have often been at the receiving end of the risk.
So on that note, let's transition to discuss the continuing crises in the Eurozone area, where ordinary savers have certainly been at risk recently in Cyprus. So let me just start out with my perspective, which I think many American economists share, or at least some aspect of it. I see the Eurozone system, especially in its current configuration, as a major economic liability, and for the countries in the Eurozone system. And I understand there may be political objectives that have driven the process, but I wanted to get your view on first, whether you share that view, and second, regardless of whether you share that view, what do you see as the most serious design flaws in the Eurozone system, and how might we go about either removing those design flaws or at least mitigating the problems that come along with them?
Do you have a more difficult question?
I thought I'd warm up.
Well, I think it is about both design flaws as well as tragic weaknesses in implementing what were meant to be the ways of mitigating design flaws, because there were mitigants, but they just weren't observed. What we've seen is a couple of fundamental things with the advent of the euro. First, Germany has been able to benefit from a weaker currency than would otherwise have been the case. And that happened at the same time as the transformation in the German labor market and in business that allowed unit labor costs to fall relative to its competitors. So the real improvement in competitiveness of Germany with the euro has been dramatic. And conversely, the growing weakness of competitiveness in some other parts of Europe, particularly in the south, has been the exact mirror of what's been happening in Germany. So the euro has widened the competitiveness gulf within Europe. Second, while Germany benefited from Europe's currency, which was weaker than what the Deutschmark would have been, the rest of Europe benefited from German interest rates, rather
Yes.
than the higher interest rates that would have been the case. And with artificially low interest rates relative to the inherent risk of borrowing in these countries, there was a credit binge, both on the part of sovereigns and businesses and ordinary people to varying degrees in various countries. How do we get out of this situation? I think first there has to be much greater focus on the structural, which is the point I made earlier more broadly, but also specifically in the case of Europe. They're basically, however you look at it, there are three broad pieces of a solution in Europe. One has to do with getting the fiscal balance sheet in order, which is a long-term task. And there's been a lot of front-loading of austerity. I think probably too much front-loading, but more importantly, too much focus on the wrong type of front-loading. Revenue increases rather than targeted spending cuts. So it hasn't been good for growth. Second, there's been too much austerity taking place at the same time, collectively within Europe. So it's not like when Sweden had its crisis and got out of it, or when Germany went through reform 10 or 15 years ago, the rest of Europe was doing well and the rest of the world was doing well, so they could export their way out of a problem. Here you have the whole of Europe going through austerity at the same time, so you can't export your way out of it as easily. So that's the second point about austerity. That's the fiscal balance sheet and austerity. The second piece is banking, the banking balance sheet. And there too, I think there's been an inadequate focus compared to what happened in the United States. Recapitalization has been a slow process and always after the event rather than before. But thirdly, structural reforms. And that's the critical missing piece that raises potential growth. And I think it's a mistake to think that investors or markets are obsessed about quarterly performance and fiscal deficits. I mean, you get sort of short-term, day-to-day movements in the markets, but investors are concerned about growth. And populations are concerned about the light at the end of the tunnel. They've got to see a prospect of pain today leading to benefit tomorrow. And that doesn't yet exist. So an inadequate focus on structural reforms, too much focus on the front-loading of fiscal adjustments has led to a vicious cycle of weakening economies, feeding back into weakening fiscal balance sheets and weakening banks. And there is a way out of it. I think a clear commitment to medium-term fiscal consolidation, which is not just an announcement, but has to be granular enough, specific and granular enough, not just on the revenue side, but on the spending side. What will be cut, how it's going to be monitored, who's going to be accountable. Second, taking upfront the issues in banking and cleaning up bad banks, cleaning out of the system bad banks and recapitalizing the banking system. But very importantly, the structural reforms, because that's at the heart of the issue. Reforms to the social compact, which is the real issue on the first piece, on the first pillar, which is fiscal consolidation, and reforms to labor markets and to the way in which industries operate, which is structural reforms. I think it requires a lot more attention.
So I think there was considerable hope among Euro optimists that the Euro system would actually facilitate structural reforms, especially in some of the countries that have experienced difficulties under the Euro system. But as you pointed out, quite rightly, I think, low interest rates allowed them to undertake consumption, real estate booms, and avoid at least in the short term, fiscal consolidation pains. And so, perhaps counterintuitively, the Euro system, I think, actually delayed structural reforms in many of the countries that needed it most. Germany was an exception, as you also pointed out. And it strikes me that these structural problems in Europe, they predate the Euro system. Okay, they're an underlying problem. But part of the difficulties created by the currency union is it took off the table some of the traditional levers by which countries that had structural adjustment problems, especially in wages and prices, could mitigate those and deal with the crises as they arose. You mentioned Sweden as an example, which not only had the benefit of operating in a global environment that was more favorable, but could devalue. And that's been the traditional way in which many European countries have, if not fixed their structural problems, at least avoided catastrophe when those things came to a head. And that's off the table as long as the Eurozone continues to operate. in its current form. Now, I wanted to ask you, and here I'm going to confess I'm out of my depth, but I think I'm very much in yours. There's another thing that strikes me about the evolution of the Eurozone and its response to crises, which it's been a chaotic, let's say, a crisis response mechanism. And perhaps that was even more clear in the response to Cyprus than anything else. As everyone here knows, you know, the first proposed plan for Cyprus included something, the violation of the bank deposit insurance guarantees that was almost immediately regarded, and widely so, as a mistake. And I see that as the kind of mistake that is more likely to emerge when you have a politically rather than technocratically driven response, and you have many, many players in the process, including finance ministers and political leaders who've got naturally enough to speak to electoral concerns directly. That's very different than the crisis resolution mechanisms that preceded the global financial crisis, which often, as a source of some resentment, involved decisions being made in Washington, D.C. by the IMF and the U.S. Treasury. Much smaller number of players involved. Those players were somewhat more insulated from immediate political concerns. It strikes me maybe that old system, bad as it was better than what's going on in the Eurozone system now. And I wonder, you know, how you see that, and what lessons you see that for how we try to design supranational institutions to deal with financial crises.
Well, it's a very important question. I think first, the key lesson is that the political vision was an inspiring one for Europe, but they probably put the cart before the horse by going for currency, for a single currency, before a banking union and some partial form of fiscal union. Some partial form of fiscal union was in place. But we're now in a situation where we have the euro. I don't think it's a hopeless situation. In retrospect, you can say that, you know, the sequencing was wrong. It's an open question as to whether countries would be better off in the long term with or without a euro. But we are in a situation now, and I don't think it's hopeless. I think if there's some relaxation in austerity on the part of the richer countries, that for whom there's no loss of market credibility, there's no lack of credibility in their medium-term fiscal objectives, I think that would help significantly, because they comprise a very significant amount of aggregate demand in Europe. That's the first point. Second, much stronger focus and support for structural reforms, because it's not just all about pain. You need long-term capital funds that has to go into retraining a workforce, that has to go into reviving industries and creating new industries. Thirdly, very importantly, and this is a policy lesson generally, you should never underestimate the importance of uncertainty. And there is a tendency sometimes to go for extensive discussion on Cartesian solutions, about the complete solution, where you need a full banking union, a full fiscal union, and of course you can't have a full fiscal union without a full political union. Until you sort out all these things, nothing is solved. But if you ask a serious long-term investor, let alone a short-term fickle investor, what's the probability of a full banking union taking place, including all the banks in Lower Saxony and everywhere else, or all the French banks? Very low. What's the probability of a true fiscal union as opposed to some form of partial mutualization taking place? Very low. What's the probability of a real political union taking place instead of 17 and in fact 27 different legislatures? Extremely low. And what's the joint probability of the three things happening together? It's less than 1%. So it won't happen. So don't plan on the basis of a full Cartesian solution. attack the immediate problems quickly and urgently. And we know where they are. We know which countries, which banks attack that urgently and accept some degree of mutualization as you do it.
Yes, that's a very reasonable line of argument. And I was struck by, you made the comment about banking union, which I think if one of the things we've learned that I don't think we fully appreciated before the euro is how critical some degree of banking union would be in order to sustain an effective monetary union. And I think, as you also suggested, we could get some way towards banking union without full fiscal union, which strikes me as a much more difficult political challenge and perhaps not necessary to deal with the most serious design flaws. So I agree with that. Maybe you have a different perspective. I don't see great room for optimism about other types of structural reform in most European economies that are experiencing difficulties. And I'm talking about moving outside the financial system now, in product markets, in labor markets. Germany did make major structural reforms, as you suggested earlier, but the countries that perhaps needed it even more, Portugal, Spain, Italy, Greece, those structural reforms have been very, very slow in coming.
Well, and I think that's the question we should be asking. I do think that there is a realistic chance of meaningful structural reforms in the crisis-affected countries. For that matter, in the richer countries, if Germany was to reform its services sector, which is highly inefficient and protected, that would help the rest of the Europe very significantly. So it's not just the crisis economies. Mm-hmm. Ireland has gone through very significant structural reform, quite dramatic, I would say, both within its public sector and its private sector. Latvia went through very significant structural reform. It's now a booming economy, doing extremely well. You could say they were willing to go through the pain because they could remember what life was like not long before they joined the euro. And they were used to hardship, but they're booming now. They're doing extremely well. I don't think it is, the basic labor market question for much of Europe is the problem between insiders and outsiders. Insiders are protected, and outsiders, which are basically the young, women, and minorities, are not, and therefore suffer from excessively high levels of unemployment. I don't think it is socially and politically tenable to continue with that system for very long. It's inequitable. It's just inequitable.
Yes.
And I just don't see how populations are going to accept that on a prolonged basis.
Yeah, I share your diagnosis that the insider-outsider problems in labor markets in particular are quite serious in Europe, and they've been resistant to reform for a long time. On that note, let me shift to a different topic, and we could talk about the lessons from the financial crisis for hours. You've got a lot of perceptive observations to make, but I did want to raise one other topic. And as I was thinking about our meeting and conversation in advance, I was struck by the following observation, that you and I share something quite important, I think, as a Singaporean and an American, which is we both hail from countries that have a long history of immigration, or long relative to the lifetimes of the countries, let's say, in which immigrants have played major roles as sources of talent and economic vitality. And just thinking about the United States and even thinking about my own professional life, I see these benefits in my interactions with students and my colleagues on a daily basis. And Americans like to think of themselves as a nation of immigrants and the descendants of immigrants. But nonetheless, even in countries like the United States and Singapore, where it seems apparent that immigration has been a boon, there's lots of resistance and lots of concerns about immigration, and we see that around the world. So I want to get your sense really about the political economy of that, and why is it that immigration, even where it seems to have been a success, is such a sensitive political issue and what I perceive as a difficult issue for policymakers to manage. So I'd like to hear your thoughts on that.
It's a it's a big issue for all countries that are globalized. But it's an especially acute issue for small countries, and more so for a unique country, which is comprises just one city. You know, when Chicago sort of lost its competitiveness in auto manufacturing and several other heavy industries and went down for many years, there were other cities that were booming. Even New York was booming. So when one city goes down in the US, another comes up. And you can afford to wait out the cycle before the city that went down eventually is regenerated, because new entrepreneurs come in, or new government comes in, and new ideas take root. So it makes a big difference when you're not just a global city, but a country at the same time. Mm-hmm. You don't have upstate New York to move out to. You're all there within a few MRT stops from each other, basically. You're a few MRT stops from each other. And it means having to think very actively about social policy as the underpinning for your economic strategies and your national strategies. So social policy is a very important issue for Singapore. Clearly, our best future lies in being a global city, specializing in niches and domains which we can do well, where we can be competitive. And that's a constantly shifting game, because others catch up and we have to move on to new activities. But we can't resign ourselves to being operating purely for an immediate region, let alone running on the basis of domestic demand. Economic dynamism will peter out very quickly if that was the case. So you have to be a global city. And how you manage the need for economic and social dynamism, where you've got some degree of free play, you've got a flow of immigrants who tend to be hungry all over the world, with the need for social cohesion in that one city and country is a challenging task, but one which I think is achievable. I think it's achievable. We, more so than the US, I think more so than the US, but certainly in common with the rest of East Asia, we have an aging population. And the curve is a lot steeper in this part of the world than it was in Europe. And we are supplementing. First priority, try and get birth rates up. That's the best solution. And we're trying every way, but everyone knows that human psychology is involved, and it's not just a matter of pouring dollars into incentives and grants. You've got to make it a family-friendly place. You've got to make it a place where, both through childcare and education system and the social environment, people feel that it's not a bad idea to have more children, or to get married in the first instance, because our fertility rates amongst married couples is not that bad. It's over 2. Our most critical problem is that people are delaying marriage or not getting married. And it's a phenomenon you see in many countries, and certainly in East Asia. Try every way, including inventive ways, of spurring improvements on that front. That's the first priority. But where you do face stubbornness in the fertility rate, you need to make up for it through new citizens and what we call permanent residents. And that's our strategy. Don't overdo the new citizens and permanent residents business, but be able to offset a decline in the citizen population, so that you don't have a declining population in the long term. The second, you need some dynamism that comes, and plus there's some real needs in the labor force for workers that in jobs that Singaporeans, there are not enough Singaporeans for, Singaporeans are not keen on filling. And that's where we have been tightening our policies significantly in the last 3 years. Not cutting back on the immigrant workforce, or rather the foreign workforce, because they're not immigrants as such, the temporary foreign workforce, not cutting back in absolute terms, but slowing the growth rate very significantly. And we have to do it because I don't think it's a good economic strategy for the long term to get the ratio of foreign workers to the local workforce going up indefinitely. You'll have sort of cycles depending on needs, but that ratio should, as much as possible, be stable in the long term. And if you make it too easy for businesses to get foreign workers, you weaken the incentive to upgrade, to think of new business ideas, and to increase productivity, which has to be the key economic objective for any country. It's really improvements in productivity and therefore wages.
So I hear you saying it's a difficult balancing act to get all these margins right, and I see that. And how much of it is also just a matter of education of the population? Do you think that the average Singaporean voter correctly perceives these trade-offs that you've just described?
I think in an intuitive way, yes. I think I don't think people are irrational. I think in an intuitive way they do sense a trade-off. It's hard for people to look long-term in any country. In fact, no population anywhere in the world looks really long-term. But in an intuitive way, people sense a trade-off. They do want economic dynamism. I mean, every survey shows that people are concerned about the quality of their jobs, and they want their standard of living to improve, which means incomes going up faster than inflation. They want it. That's the top priority in Singapore. So they do appreciate the need for economic dynamism, and they do appreciate the need for foreign workers to be part of that solution so as to sustain dynamism. But they do also want it to be their society.
Yes.
And I think it's an entirely reasonable motivation. They want it to be their society in the neighborhoods where they live, as well as in the workforce. That it's not a place where Singaporeans will ever be in the minority. It's got to be a Singaporean society, and that's true all over the world.
Yeah,
Citizens want it to be their society, supplemented by foreigners with the right skills.
Yeah, I think that's the nub of the issue in many cases. Beyond the economic, there are these social and cultural sense. People want to feel comfortable where they live and where they work, and for many people that means having a sufficient number of people who have similar cultural backgrounds to the one that they're accustomed to.
Yes.
So let me maybe open up the floor now to questions